Welcome, everybody. I'm actually super excited about this panel because everybody knows what's happening these days. I think it has kept the whole industry awake at night throughout the month of January and good part of this month. We're going to be talking about what's happening in the markets, but we're going to be talking mostly about how it's impacting our industry, all the different players, where this comes from, and how to interpret all of this. So please welcome all the speakers. I'm going to ask each of them to introduce themselves in 2 lines so we can get right into it because we have 30 minutes for the whole discussion, so I want to dive. John.
Good morning, everyone. John Murillo, Chief Business Officer at B2Broker Group of Companies. We are a liquidity and technology provider.
Thank you.
Hello, good morning, everyone. My name is Firdaus. I'm the Head of Business Intelligence and Partnership for Trading Pro, a company based in Malaysia. I'm a father of 5 kids as of now. And what we are doing is basically we are the best spread broker, and we are offering good trading conditions to all our clients. And I'm happy to share the stage with all my subordinates here and enjoy the session. Thank you.
Thank you for that.
Hi everybody, my name is Abhijit Shah. I'm the CEO of Emirates Gold. We are the first refinery of UAE, and we are 33-year-old, and we basically deal in physical gold and silver in the UAE market specifically, and export to Asia also.
Thank you, Abhijit. Louis.
Good morning, everyone. Louis Hems, Commercial Director at Dubai Gold and Commodities Exchange. We are predominantly a derivatives exchange and also precious metals spot market. We're owned by DMCC, which is world-leading free zone operator based out of JLT. And look forward to the session. Thank you.
Perfect. Let's get right into it. So, I have a very bold statement to make, and I want all of you to challenge it. I have a theory that this craziness in the price is driven, it's a conspiracy theory. It's driven by crazy Trump and his amazing friends, BlackRock, Vanguard, etc., just following some decision of Trump to all of them go long so they can all become even more rich. What do you guys think? What has been driven the prices so high so suddenly? Louis, you're laughing. Go for it.
I'll give you a challenge to that. First of all, I should say, as a government-owned exchange, can't give forward-looking statements, that little disclaimer at first. If you look at the gold and precious metals space, there is an underlying fundamental that keeps it buoyant, and that is the central bank buying. You know, in the last 3 years, they've bought more than double what they historically bought, and that gives the gold price in particular like a real foundation that you can have faith in. And of course, gold's been a long time hedge against uncertainty. So during uncertain times, it's staying buoyant. So I think that is primarily what's keeping it in a bullish market, rather than exactly what Trump's up to.
Okay, so central banks, Abhijit, do you agree?
I think a lot of it is also driven by the physical demand. So if you see the physical demand from last 5 years has almost tripled. So the volumes which we were doing in 3 years back, we are doing double than that. So people are believing more in hoarding physical. Like if you see countries like India, China, there is tons of gold just going into households and not coming out. So that is obviously driving the price up, because the movement of physical is very crucial now, and everybody wants physical. They don't even want to buy the ETFs or the paper gold. Everybody wants that 1 bar coin in their house or in their, as their investment. So I think a lot of it is driven by the physical demand, which we have seen over the last year. It has been tremendous. We have been working 24 hours just producing bars and coins. So that shows that there is clear demand of physical, and that is driving the price up.
You think they're getting FOMO?
Yeah, looks like that.
Yeah.
Because we have people just walking in and they want to buy a bar or a coin. They don't want to do the paper investments or anything. Mm-hmm. So that is definitely driving the price and the demand a lot up.
Firdaus, do you have a different opinion?
No. As much as I want to agree with the theory, conspiracy theory, but I have to agree with Luis and my colleague here that the central bank is buying aggressively for at least for the last quarter of 2025. I think based on the World Gold Council, 37 billion of worth of gold been bought by these central banks in the last quarter of 2025. That is 37 B of worth of gold, or maybe 300 tons of gold being bought or purchased by the central bank. And this has driven the gold price up. And on top of that will be the physical demands of, gold being be bought by people, especially India and China. And also some people in Asia, I'm from Asia, we love gold. My wife is crazy about gold, my mom crazy about they buy every month. So, yeah.
How about you, John? Do you have a purchase for gold FOMO?
Certainly. Look, we're in markets where, price action is everything. If the institutional players see an opportunity, given the fundamentals behind whether it's a central bank, take on the market and how the gold historically has been a hedge during high periods of volatility anyways. As a safe haven, you get quite a bit of momentum, and institutional players position themselves in the market in order to follow the trend. Naturally, the byproduct of that is the retail space comes in and they follow what others have already done. We've seen this price action to the upside quite aggressive, and I think we're going to move into the next few questions where I would like to elaborate how that impacts our industry.
I was going to say, if it is the central banks and the retail users following kind of a FOMO or culturally buying more, let's say, what's the impact? Where's the hedge? Because usually gold is paired with like S&P or USD. What does that mean? Is USD going to crash? And what's that impact in our industry? Because like it or not, at the end, it's Forex, it's currencies, stable coins are also paired to the USD. What would this mean? Does that make you nervous? John?
I'll take it. Look, I think this is a time where many businesses are being put to the test from a risk management perspective. What type of foundations do you have laid out? How do you play this market? What sort of sophistication you have in place? A lot of the industry that we all participate in here have had this concept that, markets are always going to turn in their favor. But when it's a one-way direction, you really need to know what sort of balance sheet you have at your disposal in order to take risk. This is when things become a little bit more complex. And the way that gold markets, especially spot gold, is structured, and not just gold, here's precious metals in general, gold, silver, etc. In our industry, as an OTC product, it's sort of limited. That supply, so to speak. A lot of people think that liquidity in the gold market is infinite. It isn't. You must know, you need that dialogue specifically with guys like ourselves, who we outsource liquidity from tier 1 banks and non-bank LPs. What sort of dynamics lie behind in order to facilitate that service to your end user, being the retail customer? And most importantly, at a time like this, P&L is obviously one element, but how do you price gold according to the conditions? And I think there's a tremendous disconnection, especially in the retail space, assuming that gold markets in high periods of volatility behave the same way as during calm markets. And I think that is what leads today our industry into a bit of a problem, because you have this disconnection. Liquidity consumption becomes a very significant part of your business, because there's going to be tremendous market impact once you put a trade in the market. And obviously everybody's pricing a lot more defensive at a period like this. So tech becomes a key to how to manage your book of business, essentially.
And solid liquidity partners as well, because I don't know if you have seen the same, but I've heard so much in the last month that a lot of liquidity providers stopped accepting orders on gold. The liquidity basically stopped on so many levels, and at some point many brokers had to market make all of it, or many of it, a lot of it, because they couldn't even send the liquidity through.
I think here, sorry, I'll take on this one for a second. Here comes down to your partner. Are we able to facilitate that service? What sort of lines that partner actually has out there in the street? Because obviously everybody needs to hedge at a time like this, or majority of the brokers, obviously, given the correction we've seen, have flooded LPs across this particular floor and open accounts with us and said, you know what, we need to de-risk a bit. The facilitation, whoever facilitates you a service, it's someone that needs to truly understand the dynamics behind and how it works. We never stopped pricing, for example, but that we were in very close communication with our partners. They were in line with, there has to be a connection between market makers, the brokerage that you deal with, and ultimately your business. And whoever does liquidity management at that operation needs to have the expertise to be able to communicate with us and have realistic expectations. So you see, it all boils down to communication and knowledge, and knowing who is your true partner behind the scenes.
Thank you. I want to hear everybody else about the previous question and this one. So the risk is USD. Is our industry going to collapse?
I'll go for this. Okay.
Closer.
If you see de-dollarization, it is happening. It is very much happening. If you see the countries like BRICS, they want to come up with their own currency. If you see countries like UAE and India have directly started dirham and rupee trading. So in fact, when we sell gold, now we are getting money in dirhams directly from India. So definitely there is an effort to move away from the dollar. But of course, it's going to take time. It's not going to happen overnight. Cryptos is also helping to get out of USD. Although still there will be one common ground, which is as of now US dollar. But I think it may be replaced with gold at a later stage also. Because ultimately all the central banks have been moving their treasuries to gold. So gold is only the one catalyst which looks like to be common amongst most of the economies. So that is what my perspective is, that maybe 5-10 years down the line, everything might be XAU paired with XAU or that way. But I see de-dollarization happening definitely over various countries, and especially BRICS are making a big effort.
So are you saying that eventually it could be that, you mentioned crypto, could it be that crypto, instead of being paired to dollar or say, BTC USD, for example, it would be paired to gold?
Yeah, possible. If you see, even Tether has bought immense amount of gold, and they've launched Tether Gold also. So,
okay.
Looks like we are going in that direction, but I don't know. Let's see.
Yeah, just to add to that, one initiative we've got this year on DGCX is to launch same-day gold, but it will be quoted in dollars because market convention, but settled in dirhams, which is going to give the local market more efficiency in terms of bank timing and so on. Also, just to go back to that first question, to me it's a lot about the trade or institution appetite for risk, because obviously having a lot of diversification in multiple asset classes is going to reduce risk. So if I wouldn't suggest someone just goes completely long gold and just has one product, right? It's going to be quite risky. So the more diversification, less risk, but obviously it does dilute some gains overall. So it comes down to risk appetite, in my opinion.
Okay, Firdaus?
Yeah, for me, I think for the recent month, most of the brokerage for the risk management team, they are being so busy managing the volumes, managing the orders, right? For us, we also being a little defensive on taking orders from the clients, from the traders, by implementing some of the risk management, like reducing the leverage, turning on some risk management tools on our system, on our platform, so that we keep the exposure of the risk at the very minimum level from our side. And I'm excited to hear from my friend here to see the other instruments being paired in the gold in the future. But I also believe that it will be that direction. Maybe, I don't know, 5, 10 years down the road. And I believe gold will be the main commodity or the main instruments in the coming years from now.
So if I'm hearing you all, you basically, despite the spike in price and the very small correction now, you don't believe at all that this is speculative and that there's going to be a major correction, or that gold has gone from being a safe haven to being a speculative asset? Luis, you're smiling.
We cannot predict the future, right? So, I mean, yeah, technically it's become both a safe haven and a speculative asset. Will there be more corrections? Possibly, but the fundamentals are there. It just depends on how long the confidence in that product stays. And if there is more and more retail coming into the product now, eventually it will have to correct according to its real value. But I think for now it's still bridging both safe haven and speculation.
Okay. Abjit, do you share that?
I would say it's more of a safe haven currently, because that's why most of the central banks have been buying for such a long time, and they are long. They are not hedging it or anything. Secondly, if you see, the cost of mining has gone from $750 to around dollars per ounce to $1,500 to $1,700 per ounce, and typically the gold price has always been double of the mining cost. So ideally, the lowest you can see is around 3,500 to 3,200 now, even if there is a nosedive correction, because
that would still be major now.
yeah, that would be major now. But yeah, below that I don't see it going, definitely.
I mean, the price hike, I think that it has put this industry to the test, and so much strain on every single layer of the players, because like you were saying, it was unidirectional. And it lasted a very short amount of time. So, I mean, it's still there, but there has been some degree of correction. If this lasted longer, any longer, you're laughing, yeah. What would happen? Tell me, Firdaus.
But I don't believe that it will be a longer correction.
But what if?
What if? Okay.
What would happen to this industry?
It will remain the same, but the brokers might feel a bit of relief to what is happening, or the rally of the correction. I think the broker will have a slight relief on what is happening, and that will give some time for the broker to revamp the risk measurement or management in the broker itself. But I think it will give another space or room for the gold to jump even higher in the future.
Okay. Do you want to add something, John?
I think we would have seen a lot of surprises.
We would have seen a lot of surprises, not necessarily good ones, huh?
That's correct. I'm afraid that a lot of it is, not truly exposed out there. Some businesses were very fortunate that correction took place. We speak a lot to our partners on an ongoing basis. I listen to their pain and challenges and so forth. Look, there's always going to be a market out there for someone, right? There's going to be a winner, there's going to be a loser. That's just a natural process of the industry we're in. It's more to do, how do you manage that? What sort of mechanisms are behind to mitigate risk? That's what it comes down to.
Correct. Let's talk a little bit more about that point. So what are the lessons that we have learned from this? And what are the different distinctive elements that you have seen that have taken place? Like you mentioned at some point, the prices were adjusted for liquidity. I don't know. What else?
Well, I think the key point specifically for this particular industry is, how do you reprice margins? Now it comes down to balance sheet on our side and everyone else's, and their discretionary call on every single customer. How do you want to pass on those margin requirements that are being implemented on us as an LP, and therefore we have to distribute that liquidity to guys like yourselves? But then how do we go about that? Because if I just pass on what I get, you probably would not do business with us at all. So here is where you have to find that business balance, I call it. How much balance sheet are you willing to utilize? And what you learn at times like this is even though you may lose some business because not everyone is going to be thrilled with the idea, if you actually apply that margin accordingly as per our institutional rates, maybe not to that extreme, but you mitigate that risk to some degree. You avoid customers going into negative equities. During these big moves, anyone can get wiped out in no time, and that could eventually have an impact on businesses like ours. But it's also about, I always said, there's something very important here. You as an LP have a duty to educate your partner how the institutional world works so that you don't have unrealistic expectations. I think there's some LPs trying to gain business, trying to be super aggressive, and what they're doing is just extending balance sheet to levels that is completely unsustainable. And it's only a matter of time until those guys blow up. I'd rather be the old man, the conservative approach, but know that I'll be here for the next 20 years, stronger and better. So I think what you learn from times like this is being conservative is not a bad thing. It just guarantees that your counterparty will be able to honor their responsibility towards your businesses. And I think that's really the problem we see here today. Everybody wants business, but not all business is good business. And you have to sometimes accept that.
Yep. Firdaus?
Yeah, I believe when John talked about balance sheets, it affects our broker's balance sheet as well. And then when the time we realized that the longer the trends of the gold, it will affect our broker's balance sheet as well. So we have to be very defensive on our business model, on how we accept clients, especially, recently we just, restrict some countries that heavily trading on gold. For example, I know China is one of the country that been most of the LPs, they don't like to take China client because they trade heavily on gold and a very short period of time. So yeah, that what we learn as a broker during this time. So number one is the trend is not our friend as a broker because it affects our balance sheet, and we have to be very defensive on our strategy on approaching these clients.
Yeah, Abhijit.
I believe the only thing which can protect you from a downtrend is liquidity. If you keep liquidity and you are trading, it's fine. You can service your margin calls. The margin requirements increase during that time always. So we tend to keep a very conservative approach, like our friend said. So it's better to always be liquid and service whatever you can during a fall. Because, if you see gold, it went up to 4,400, 500 during the fall. But again, it's back to 5,000. So it was just about surviving that moment, your positions to survive that moment. So we do keep a lot of liquidity during tough times, and then that helps us to get out of any trouble which can come from the market. Also, if you see, the disparities are very high in various exchanges during that time. Even though silver was down so much, in Shanghai it was still trading $10 or $11 above normal price. So that is a time you can even take benefit of such by creating up positions between various exchanges.
Mm-hmm. Thank you. Luis?
Yeah, just to add, I've always been of the opinion that exchanges and the broker markets can coexist and should coexist side by side, because they offer different benefits for the marketplace. For example, on DGCX, we have the physical gold and physical silver that you can buy with effectively zero counterparty risk, so great for storing value. But also we have cash-settled futures, which are very tight in terms of spreads now, on par with the best spreads in the exchange space. And we've seen our volumes grow a lot in the last 3 months, and that is really reflective of the local market here understanding the value of hedging. So I think one of the big lessons that can be learned is like the importance of hedging alongside your physical exposure.
And you just mentioned physical gold, so I will briefly touch upon it. What has been the relationship, and what do you think is going to be the impact in terms of physical bullion flows and derivatives pricing? And is there enough physical gold for everything that is being purchased, or is it just all smoke?
I think I'll answer it from this perspective. I think as long as the trading community understand the different value between physical, which is more long-term store of value, it's more simple, you can hold it in approved vaults and it's very stable, versus the paper market, which is more efficient, more liquid, faster. So as long as you use both according to what you need as a trader, I think you're going to be absolutely fine.
Do you all agree?
Yeah, I think I agree because, of course, there is not that much gold which is getting traded in physical form. There is a limitation to getting physical gold. So you have to always balance between both the sides. And for hedging, we need to use the exchanges. So it's all, but we from time to time convert our hedges into physical always. But yeah, there is definitely not that much amount of physical gold which is getting traded in the world.
Okay. Firdaus?
Yeah, I think one of the reasons why the gold price is going up is because of the less production of gold in the world right now, and plus the highly demand of the gold from, for example, the retailers and the central banks. It drives up the price for the gold. Yeah, it's for the physical gold. I believe that it is for the long-term investment, or it's for your safety net or whatever. But for derivative, it's more on the short term that will drive the volatility of the price in gold.
Okay. John?
Just to add on this very quickly, something. A couple of weeks ago, right, when we had that sell-off, it all got triggered by the fact that CME increased margin rates from 6 to 8%. And that caught everyone by surprise. And then auto liquidations kicked in. And then, of course, the whole fund management space saw that as a sell-off opportunity. And here we are today. History was made, big drop, etc. What that moment showed us is the importance to be prepared in the markets that we trade. Look, ultimately, the banks that are pricing us, and effectively we are pricing this entire industry, is being hedged on CME, or at least majority of it, correct? So we need to know these things. Margins are dynamic. Margins should never, anyone who believes they're static, they're under a different, unfortunately, they have a totally different perception of how the markets operate. I think, again, and I say this in every single panel, it comes down to that communication with your LP. If it's too good to be true, it's not real. Like, for Christ's sake, I think common sense will always prevail. And anyone who's pricing you extremely aggressive, it's unsustainable. There will be a time where that balance sheet will get stretched, and the stories that follow.
Yeah. We only have 2 minutes left, so I'm going to ask you to give us your 2026 outlook. It's the first event of the year. So is gold volatility the new normal? What do you think about 2026? How is that going to impact the rest of the year? Are the waters going to calm down? Can we expect it to go up again? What's your take? John, I'll start with you.
All right, so no predictions. Just kidding. I do believe there's going to be tremendous
being
volatility.
Recorded, huh?
Yeah, being recorded. So I suspect we will move into the 2-3% daily fluctuations. That's becoming the norm. The problem is that now we're looking at a 5,000 rate, whereas gold used to move 1.5% on average daily, but we were trading at 2,500 back then, just a year ago, right? So your models, especially for those who manage risk, need to be adjusted to the new conditions, what I consider the new norm. Volatility is here to stay. Definitely, we will have, I think, midterm elections in the US this year. That's going to get pretty interesting. We have a new chairman coming in. God knows what that will bring. But I do see hell of a volatility ahead. And what you need to be ready for is how to manage that and come to partners that have that expertise towards.
Firdaus?
The outlook is, I always believe that gold is bullish all the time because I've seen for the last couple of years, the gold has doubled the price from 2,500 to 5,000 in less than 2 years' time. So we can see the price, or we can forecast. I don't want to make a prediction here, but I will see the gold to climb up to 5,500 or even to 6,000 by the end of this year.
By the end of 26?
Yes.
It's been recorded. We're going to quote you. Abhijit.
Yeah.
Yeah, I do believe that there will be a lot of volatility this year, and it is already, we are seeing it from January itself. But on the physical side, the demand is still there, and that makes us believe that definitely we will see 6,000 this year for gold. And interestingly, there is more demand of silver physical, which a lot of people have been ignoring. But as one of the refineries in UAE, we have processed around 50 tons of silver in January. So there is so much silver physical demand also. So I believe there will be a big upside on silver as well this year. And we have good flows till, we are booked already till March. So I do believe that although there has been a fall in silver, a good one, but still we might see it touching also 150, 140 this year.
Okay, 2 votes for for the raise of the prices. More volatility. What do you think, Luis?
Yeah, I think it's fair to say we've moved from an era of macro trends, looking for Fed rate changes, and traders adjusting accordingly, to more of an event-driven market, and that seems to be here to stay. I think one thing I would say is that Dubai and UAE as a hub for gold and bullion dealing looks set to stay, and I think that growth will continue. And yeah, as long as we have more events like this, it's good for the trading community to share ideas, and yeah, that's it. Thank you.
And make connections, because apparently you need stronger liquidity providers, guys. So make sure to have good channels, because volatility is coming your way as well, again, between now and the end of the year. So thank you so much, all of you. Big round of applause for our speakers, and thank you for listening.
Thank you.
Thank you, guys.